Mike Maloney just made his boldest prediction yet. Silver will hit triple digits, potentially $150 to $500 per ounce, and he's backing it up with math, not hype. Here's what's happening right now. Silver just broke $70 per ounce for the first time in history, up 150% in 2025 alone. But according to Maloney, this isn't the top. It's just the beginning of phase 3 of the bull market, where the greatest gains happen in the shortest time. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, currently sits at 84:1. Historically, that ratio averages 40:60:1. During the 1980 precious metals peak, it hit 15:1. Today's ratio means silver is dramatically undervalued compared to gold. But there's something even more alarming. There are 401 paper silver ounces traded for every 1 real physical ounce. That's not a market, that's a house of cards. When that leverage unwinds, silver prices will explode, and industrial demand is crushing supply. Silver is now critical for solar panels, electric vehicles, electronics, and batteries. Global stockpiles that used to exist above ground? Gone. Mines can't keep up. We're in a 7-year supply deficit with no solution in sight. Mike Maloney, the man behind Hidden Secrets of Money, with over 100 million views, has been tracking precious metals for 30+ years, and he's saying silver is his highest conviction trade, not gold. Silver. In this video, I'm revealing why Maloney believes silver will outperform gold by 4-7x, how the gold-silver ratio predicts triple-digit silver, what stored energy means for the coming price explosion, and exactly how many ounces you should own before it's too late. But before we dive deep into Mike Maloney's silver thesis, if you want to protect your wealth and catch the precious metals bull market before it's too late, subscribe to the Investor's Lens. We reveal the opportunities Wall Street doesn't want you to see. Hit subscribe now. But there's one metric about silver that is by far the most important indicator of massive price moves, and most investors have never even heard of it. It's the gold-to-silver ratio, and right now it's screaming that silver is about to explode. Let me explain what this ratio means. The gold-to-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, with gold at around $3,600 and silver at $70, the ratio is about 84:1. That means you need 84 ounces of silver to buy 1 ounce of gold. But here's the critical insight from Mike Maloney. Throughout history, this ratio has averaged 40:60:1. When gold and silver are priced fairly relative to each other, you need about 40-60 ounces of silver to buy 1 ounce of gold. At 84:1, silver is dramatically undervalued compared to gold, and the historical patterns are stunning. In 1980, during the last precious metals bull market peak, the ratio hit 15:1. Silver was $50 per ounce and gold was $850. That means silver outperformed gold by a factor of 5-6x during that bull market. In 2011, the ratio briefly touched 32:1 when silver hit $49 and gold hit $900. Again, silver massively outperformed gold. Maloney calls this stored energy. When the ratio is high, meaning silver is cheap relative to gold, there's stored energy waiting to be released. When that energy releases, silver doesn't just catch up to gold, it overshoots dramatically. Here's the math that should excite you. If the gold-silver ratio moves from 84:1 to just 50:1, which is the historical average, and gold stays at $3,600, silver would need to go to $72. That's already happening. But if gold goes to $5,000, which many analysts predict, and the ratio moves to 50:1, silver hits $100. If the ratio compresses to 30:1 like it did in 2011, and gold is at $5,000, silver goes to $167. And if the ratio hits 15:1 like it did in 1980, and gold reaches $6,000, silver explodes to $400 per ounce. Maloney's prediction of $150, $500 silver isn't some wild guess. It's based on historical ratio compression patterns that have played out multiple times. But why does the ratio compress? Because silver has a dual nature. It's both a monetary metal like gold and an industrial commodity. When precious metals bull markets happen, both gold and silver rise. But silver's industrial demand adds rocket fuel to the move. And there's a technical chart pattern that Maloney has been tracking for 45 years. The ratio hit an all-time extreme of 120:1 in 2020 during the COVID panic. Since then, it's been compressing, moving from 100:1 to 84:1. That's already a 30% move in silver's favor. The long-term chart shows a massive breakout pattern. When the ratio breaks below 70:1, which Maloney believes is coming soon, it typically accelerates to 50:1, then 40:1, then potentially 2015:1 in a blow-off top. Every time the ratio has reached extreme levels above 80:1, it has compressed dramatically over the next 5 years. We're at the beginning of that compression cycle right now. If you understand this one concept, the gold-silver ratio, and its mean reversion tendency, you understand why Mike Maloney is more bullish on silver than gold. The stored energy in the ratio is about to explode. And when it does, silver will outperform gold by 4 to 7x. The question isn't whether the ratio will compress. History says it will. The question is, are you positioned to profit from it? But the ratio is just the monetary argument. The real crisis is in physical supply. This next factor is perhaps the most alarming because it reveals a physical shortage that cannot be solved by printing money or manipulating paper markets. It's the supply deficit. And we're now in year 7 of silver consumption exceeding production with no end in sight. Let me give you the numbers. In 2024, global silver demand was approximately 1.2 billion ounces. Global mine production was only about 850 million ounces. That's a 350 million ounce deficit, nearly 30% more demand than new supply. Where did the extra 350 million ounces come from? Recycling and above-ground stockpiles. But here's the problem. The above-ground stockpiles that governments and industries used to hold, they're gone, depleted, used up. Unlike gold, which sits in vaults forever because it's primarily a store of value, silver gets consumed. It's used in solar panels, electronics, batteries, medical devices, and hundreds of industrial applications. Once it's used, it's often uneconomical to recycle because silver is dispersed in tiny amounts across millions of products. A smartphone contains about 0.3 grams of silver. A laptop has about 0.7 grams. Solar panels use about 20 grams per panel. Electric vehicles use 25 to 50 grams each. None of this silver is coming back. It's gone forever, or at least until silver prices are high enough to justify the expensive recycling process. And demand is accelerating. Solar panel installations are growing 20% annually. Every gigawatt of solar capacity requires about 70 tons of silver. The world is installing 400 plus gigawatts annually now. That's 28,000 tons or 900 million ounces just for solar. Electric vehicles are adding another layer of demand. Each EV uses 25 to 50 grams of silver for electrical contacts and conductors. Global EV sales are growing 30% annually. That's another 100 plus million ounces of demand just from EVs. Add in electronics, 5G infrastructure, medical devices, water purification, and traditional uses, and you can see why demand is crushing supply. But what about the mines? Can't they just produce more? No. Silver mining is actually declining in some regions. Major silver mines take 10-15 years to develop from discovery to production. There aren't enough new discoveries coming online to offset declining production at aging mines, and about 70% of silver comes as a byproduct of mining other metals, primarily copper, gold, zinc, and lead. Silver miners don't control production. If copper prices fall and copper mines shut down, silver production falls too. Regardless of silver prices, the refiners are maxed out. The U.S. Mint has repeatedly suspended silver coin sales because they can't get enough refined silver from suppliers. Private mints that make silver bars and rounds are running 6 to 8 week delays because they can't get enough raw material. This is a physical supply crisis, not a paper market correction. And here's where it gets really interesting. Mike Maloney points out that there are 401 paper silver ounces traded on the COMEX futures market for every 1 ounce of physical silver in the vaults. That's 411 to 1 leverage. Imagine if 411 people all showed up to claim the same bar of silver. That's the paper silver market. It's fractional reserve silver. As long as everyone is happy trading paper contracts, the system works. But the moment investors demand physical delivery, which is starting to happen, the whole house of cards collapses. We're watching a slow-motion train wreck where paper price suppression meets physical supply shortage. When those two forces collide, the price of physical silver will explode to clear the market. And unlike 2008 or 2020, where the deficit was temporary, this deficit is structural. It's not going away. Demand is growing faster than supply can possibly keep up. The only way to balance this market is through higher prices, much higher prices. So if supply and demand are this imbalanced, where could prices actually go? Here's the price projection that many investors find hard to believe, but the math makes it almost inevitable. It's triple-digit silver. And Mike Maloney says it's not a question of if, but when. Let's start with the basics. Silver hit an all-time high of $70 per ounce in 2025. That sounds high until you adjust for inflation. In 1980, silver peaked at $50 per ounce. But $50 in 1980 dollars equals approximately $1,040 in today's dollars. Read that again. The inflation-adjusted all-time high for silver is $1,040. At $70 today, silver is 95% below its inflation-adjusted peak. 95%. Now, will silver hit $1,040? Probably not in this cycle. That would be an extreme blow-off top. But does it need to hit $150, $300 just to approach its historical purchasing power? Absolutely. Here's Mike Maloney's reasoning. In every precious metals bull market, silver enters what he calls Phase 3, the mania phase where prices move parabolic in a short time. We saw this in 1979-1980 when silver went from $6 to $50 in 18 months. We saw it in 2010-2011 when silver went from $18 to $49 in 10 months. Right now, according to Maloney, we're entering Phase 3. Silver has been in a bull market since 2020 when it bottomed at $12. It's had a steady rise to $70, a 5.8x gain. But Phase 3 is when it typically does another 3.5x in a fraction of the time. If silver does another 3x from $70, that's $210. A 4x move puts it at $280. A 5x move, which is what happened in the 1980 mania, takes it to $350. Maloney's $150–$500 range isn't wild speculation. It's based on historical patterns, supply-demand fundamentals, and monetary debasement. Speaking of monetary debasement, let's talk about what central banks are doing. Global M2 money supply has increased by over $50 trillion since 2020. That's a 40% increase in the total amount of currency in circulation in just 5 years. In 2025 alone, central banks added $3.2 trillion in new currency. That's not stimulus. That's not economic growth. That's debasement. Every dollar, euro, yen, and yuan is worth less because they're printing more of them. Precious metals are the opposite. You can't print gold. You can't print silver. The supply is limited by physical extraction from the earth. As currencies are debased, Hard assets like silver and gold must rise in price to reflect the currency's loss of purchasing power. Here's a thought experiment. If the money supply doubles and silver supply stays flat, what should happen to silver's price? It should double just to maintain its purchasing power. From 2020 to 2025, money supply increased 40%. Silver went from $12 to $70, a 5.8x gain. Silver outpaced currency creation by a factor of 4x. That's the beginning of a precious metals bull market. But if money printing continues, and it will because governments are addicted to deficit spending, silver needs to keep rising just to keep pace. And if investor demand accelerates as people flee devaluing currencies, silver could far exceed even optimistic projections. Mike Maloney's $150 target is conservative. His $500 target assumes a mania phase similar to 1980. Both are mathematically plausible given currency debasement, supply deficits, and historical ratio compression. The question isn't whether triple digits are possible. The question is, will you own silver before it gets there? But how do you know we're actually entering the final phase of this bull market? Here's how you know when a bull market is entering its final and most explosive phase, and all the signals are flashing right now. It's mainstream adoption. And the data shows we're at the tipping point. Mike Maloney has studied precious metals bull markets for over 30 years. He's identified a pattern that repeats every cycle. Bull markets have 3 phases. Phase 1 is the stealth phase. Insiders and smart money accumulate while prices are low and nobody cares. This was silver from 2020-2022 when it went from $12 to $25 and nobody noticed. Phase 2 is the awareness phase. Prices rise steadily. Early adopters start buying. The media begins covering it. This was silver from 2020-2024 when it climbed from $20 to $50. Phase 3 is the mania phase. Mainstream investors pile in. Your dentist is talking about buying silver. Google searches for how to buy silver hit all-time highs. Prices go parabolic. This is where we are right now. The evidence is overwhelming. Google Trends data shows searches for buy silver and silver price at levels not seen since 2011, the last major silver peak. That's mainstream awareness. Retail demand has exploded. The U.S. Mint sold 68 million silver eagles in 2024, the highest sales in years. Private mints are backlogged for months because they can't keep up with demand. That's retail buying. But here's the big change. Institutional money is entering. We're starting to see 100 million silver purchases by funds and family offices. Billionaires like Elon Musk and Bill Gates have invested in silver mining companies or silver-intensive technologies. This wasn't happening in phase 1 or 2. When institutions enter, they bring massive capital. A single hedge fund allocating 1% to silver could buy hundreds of millions of ounces, more than multiple mines produce in a year, and central banks are buying gold at record rates, over 1,000 tons annually. While they're not buying silver directly, their gold buying signals distrust of fiat currencies. That sentiment spills over to silver investors. Social media is lighting up with silver content. YouTube channels dedicated to silver stacking have millions of subscribers. Reddit's Wall Street Silver community has over 500,000 members organizing buying campaigns. This didn't exist in phase 1. The final signal? Price volatility. In phase 3, prices swing wildly. Silver can rise $5 in a day, fall $3 the next day, then rise $8 the following week. That volatility is the hallmark of mania phases when emotion drives trading more than fundamentals. We saw this in 1980. We saw it in 2011. And we're seeing it now in 2025-2026. Mike Maloney warns that phase 3 doesn't last forever. It might be 6 months, it might be 18 months. But it's the phase where the majority of gains happen. If you wait until silver is $150 to Start buying, you've missed most of the move. The time to position is now while we're in early phase 3, before the true mania sets in. So the critical question remains, how much should you actually own? Here's Mike Maloney's answer to the question everyone wants to know. How many ounces of silver should you hold? His answer might surprise you. He doesn't give a specific number of ounces. Instead, he gives percentage allocations. For conservative investors, 5 to 10% of your investment portfolio in precious metals, with a 50-50 split between gold and silver. At current prices, that means if you have a $100,000 portfolio, you'd hold $2,500 to $5,000 in silver. For moderate investors, 10 to 20% in precious metals, with a 70-30 silver to gold ratio favoring silver because of the gold-silver ratio opportunity. A $100,000 portfolio would hold $7,000, $14,000 in silver. For aggressive investors, $20, 30% in precious metals with 80-20 silver to gold. Maloney himself is heavily weighted towards silver right now because he believes silver will outperform gold by 4-7x during ratio compression. But here's his critical advice. Physical metal only, not paper silver ETFs, not silver mining stocks as your primary holding. Physical silver bars and coins that you hold in your possession or in allocated storage where you own specific bars. His famous saying, if you don't hold it, you don't own it. The 411 is to 1 paper leverage means paper silver claims could fail during a crisis. Physical silver can't default its real, tangible wealth. Dollar cost average into your position. Don't try to time the bottom. Buy consistently over 6-12 months regardless of price fluctuations. Start with education. Read Maloney's Guide to Investing in Gold and Silver. Watch his Hidden Secrets of Money series. Understand what you're buying and why before committing significant capital. Then accumulate. Build your position. Hold for the long term. And when silver hits triple digits, and Maloney believes it will, you'll be glad you acted when it was still only $70. So we've covered Mike Maloney's 5 pillars for why silver is heading to triple digits. The gold-silver ratio at 84 is to 1 holding massive stored energy, ready to compress to historical 40-60 is to 1 averages. The 7-year supply deficit with 350 million ounce annual shortfall and above-ground stockpiles depleted. The triple-digit math showing silver at $70 is still 95% below its inflation-adjusted $140 peak from 1980. The Phase 3 bull market signals, with mainstream adoption, institutional buying, and retail mania beginning, and his allocation guidance favoring physical silver over gold at current ratios. These are the insights that separate investors who catch generational wealth, transfers from those who watch from the sidelines. But here's something I didn't tell you at the start of this video. Everything I just shared is completely useless if you don't know where to actually buy physical silver, how to verify authenticity, how to store it safely, and which dealers are reputable versus which are scams. Without this practical knowledge, you could lose thousands to premiums, fakes, or storage problems. Comment under this video, and I will reveal the complete guide to buying and storing physical silver, including the exact dealers I use and the storage solutions that protect your wealth. I'll see you in the next one.